Great. Welcome to this special webinar, How to Build a Solid Portfolio, Strategies for Stability and Growth. Hi, I am John J. Hardy. I am Saxo's Global Head of Macro Strategy. I'm just your friendly host for the day. The star of the show will be Ruben Dalfavo, our investment strategist, who will be taking you through today's program. And it's a great one. Just to start off, I want to say a couple things by way of intro. Who is this? And by the way, apologies for the sound on my side. We had everything all beautifully set up yesterday, and then suddenly the camera was not working in the studio where Ruben is. So if you're hearing any errant noises on the trading floor, that is why. All right, who is this webinar for? Look, this webinar is really for anybody who is looking at some systematic way to build a portfolio, some fundamental principles, some guiding principles for how to get a portfolio moving ahead and setting yourself up for whatever returns the markets can offer you, basically for life. Whether that's, again, if you're just starting out and you want to get something going for the first time, whether you've been going for a while but have been doing stock picking and haven't found success with that, or want to add some kind of core principles overlay to that. If you're a Danish attendee and you've been thinking that the simplest thing to do is to be simply long Novo Nordisk for life, you've discovered that strategy hasn't worked, for example. There's the issue of home bias, and we will talk about principles for spreading your eggs outside of your own home market, etc. It could just be for anyone also that just doesn't have a plan. So this is a webinar for getting a plan. So what you will hear are those fundamental principles that are going to set you up for longer term success. Success being defined as whatever those market returns, general market returns that are available for you in the coming years for building your wealth. It's some principles as well along those lines of portfolio allocation, stocks and other instruments. And then as well, I think a really important one for people that don't want to take a really strict, super broad, overly passive approach. In other words, just saying, I want to buy, quote unquote, the market, ways to add some flexibility into building a portfolio. But the overall writing principle, I'm sure Ruben will agree, is that your time that you spend with your investments in the market will always beat, in the long run, trying to time the market, thinking when the market is expensive and you need to sort of get out and go into cash, and when it feels cheap and you need to get back in. As a group, investors and the general public has been proven very poor at timing the market over the years. What you will not find in today's webinar is any specific investment recommendation or course of action. Certainly not any specific instrument selection. So if we mention any ETFs, indices, instruments, please keep in mind those are, for example, and illustrative purposes only. Those are not investment recommendations. Your individual risk appetite, your age, where you are in your financial life, and your circumstances are all going to be unique. So again, for examples and illustrative purposes, educational purposes only. All right, very briefly, just for a couple of points here or on who we are. I'm again John Hardy. I'm global head of macro strategy with Saxo Bank. I spend a lot of my time trying to figure out what's going on in the world and really day to day, and where things, what's happening now, where are things going to go in the coming even one day, but several days, a couple of weeks, a couple of months, and trying to do that timing of the market bit, if you will, across instrument classes. A very difficult task for sure. That is not at all what today's session is about, and that's why I'm not the main star here. That is Ruben Dalfavo. As you can see, he's quite a young fellow, certainly compared to myself. But he's not a young fellow in terms of, I think, his investment wisdom. He's an old soul, I think, in terms of that investment wisdom, and I hope you absorb some of it today. This is not about fast markets and crypto and meme stocks and the like. It's about choosing quality companies and quality approaches for the long run, because compounding, who is it that said it, Ruben? I'm forgetting, is they call the eighth wonder of the world. I think I'll agree with that. And
Yep.
Final point before I hand it over to you, Ruben, is there is a little questions section at the top right in your webinar screen. You can click in there if there any question arises while we're running through the presentation. We do want to allow some 10 minutes plus at the end of this for any questions. I'll try to round up a couple of those. Apologies, I'm sure we won't be able to get to all of your questions, but we'll try to address as many as possible in the time allotted. Final information point, this will be recorded. If you find the concepts useful, but you think you might want to review it, you can look for it on the same page where you sign up. You can just look Google Saxo webinars in your browser, and you will find a link to the page, and down the bottom, after some period of time, I forget how long, this automatically appears as a recording, and you can review it, you can pass it along to somebody else, all that good stuff. So this is not a one-time only live event. It will also be recorded for posterity. So in any case, I think I'm going to hand it over to Ruben now, and I'll be quiet, and you can introduce yourself a bit more thoroughly and get going with today's awesome topic.
Absolutely. Thanks, John. And just a quick note, the quote was from Einstein on compounding being the eighth wonder of the world. So
yes, of course, I always forget.
was quite a quite a reference. But yeah, let's get started. Welcome, everybody. Thanks for joining the webinar. Just 2 words on who I am. So I'm here an investment strategist at Saxo Bank. I joined roughly 6 months ago, and I try to I have a deep belief in the power of long-term investing, and I also think that informed decision making can help everyone actually obtain quite good results in the stock market. And as John mentioned, there is this wonder that is compounding, and you need to have the patience to let it do the job for you, basically, and let the interest and your returns earn more returns on top of the returns. So I have an academic background in the economics and business administration from both the University of Florence and the Copenhagen Business School here in Denmark. But I've always been super passionate about long-term investing. It's something that I've been doing since early 20s, and it's been more than 10 years now. And I really spend a lot of time trying to figure out what makes some companies stand out and what makes them kind of steady compounders for many years. So what are the characteristics that actually differentiate kind of a normal traditional company from a very strong steady compounder that can generate 20+% returns over the long term, yearly compounded. And of course, I'm inspired by the Warren Buffett and Charlie Munger approach, focusing on high quality companies, capital discipline, excellent management, and sustainable high returns. And beyond investing itself, I also care about kind of empowering people to participate in the markets, to benefit from compounding, to understand what are the underlying dynamics in the stock market, what drives the returns. And I always try to do it with very clear, honest, and data-based communication. So hopefully you will find this webinar useful and practical, and I will try my best to keep it very practical and cut through the noise, and just, I've only 4 parts, very actionable. And so hopefully you will also enjoy and find it useful. So here's the roadmap for today. We start with why diversification matters, kind of a key rule for investing. And I do think we should spend a few words on why that is relevant. And maybe I'll even touch upon why investing is relevant, not only diversifying, but let's take a step back and talk about why investing is even relevant. After that, we will talk a little bit about risk and risk tolerance. So you might find some definition of risk that are new to you, but I think it's useful to see risk with a proper framework to assess what risk and what is your risk tolerance as well. Then, of course, I will just touch briefly on compounding. I will provide a little example to make it very tangible, because I feel like sometimes it can feel very mathematical, very abstract, but it's actually something very, very real and tangible. So I will provide a little example on that. And finally, which I also think is the most interesting part, is how to build the portfolio. So portfolio construction strategies. I will elaborate a little bit on that. And finally, I will just show you how to select instruments and find information on companies and investing in general. We will keep 15 minutes at the end for Q&A, but feel free. I'm more than happy to stay even longer than that. So if we go a bit over time, no issue for me. I'm happy to stay half an hour longer or however is needed. So happy to take any questions you have. But before we dive right in, just a kind reminder that whatever I say is just for educational and informational purposes only. It does not constitute financial recommendation or any solicitation to buy or sell any security. So whatever I will show you when I talk, also maybe some company specific names, or it's just pure examples. It's just for inspiration. And of course, investing always involves risk, including risk of permanent loss. We will talk about risk more specifically, but as a general rule, you should only invest in products you totally understand and you have done the due diligence yourself, the kind of the research yourself. So here, I'm just here to provide some inspiration and educational information only. Okay, part one is about the why. So why investing matters and why diversification matters. And that we will see that investing is very key to even just preserve the purchasing power of your money. In fact, investing, I think the main reason why we invest is not even to generate any return, because as we know, inflation is silently eroding your cash. So in a way, you're becoming poorer and poorer every year if you're not investing your money, because there is a kind of a fee, a silent fee on your cash that is called inflation. So as prices rise over time, uh, basically the same amount of money will enable you to buy less goods and services. So in the first reason why people should invest is just to protect and grow your purchasing power. So it's not even to grow wealth. It's just the very base case is just to keep the value of your money as is today over time. Of course, ideally, and we will see also later, that in most cases over a long time period, investment generates returns above the inflation rate. So of course you can also generate wealth, but I think not acting and keeping everything in cash can feel very safe, but it's also a choice and is eroding your, it's guaranteed to generate negative returns over time. So even doing nothing still is a decision and still has a cost. I think this is very important to highlight. But before we talk diversification, I think it helps to know also what type of assets are available to you as investor. And of course, we all know, hopefully, that you can buy shares or stocks. So basically, it means owning a little piece of a company. And returns can come from kind of the compound growth of the stock itself or dividends. So hopefully people will also remember that this owning a stock is actually owning a small part of a company. So sometimes I think, especially for long-term investors, it's easier to get carried away by looking at the number and maybe looking at negative or positive returns. But always remember that the underlying business is what really matters in the long term. There is a 100% positive correlation with the earnings of the companies and the share price. So don't stop just looking at the share price, and remember that there is also kind of a business that you're owning when you buy a stock. Then you can, of course, buy bonds, which means that you're lending money in exchange for an interest. And that's often less volatile, a bit more steady than buying shares. But historically, over the long term, the returns are also lower. And most of your returns, depending on the type of bond, but they will come from the coupon, which is the interest that you're earning on your principal. Then you have funds, for example, ETFs, exchange traded funds, which are basically a basket of investment that you can, in most cases, buy in one single trade. So those enable greater diversification and can make kind of investing a bit easy because it's less volatile, it's a bit more steady, and you are immediately gaining access to many different types of industries, often different type of companies. So it's just a simple way to build kind of a diversified portfolio in just one click. And
Ruben,
yes.
this is a great overview here. I was just thinking, we had this experience back in 2022 when the central banks all started jacking up interest rates because of the post-pandemic inflation. So there's a lot of questions rolling around about the role of bonds in an investment portfolio after that traumatic year where traditionally there was this idea, for at least for a couple of decades, where when stocks were doing poorly, bonds would be really, really heavily bought and interest rates would fall, meaning that those bond returns were suddenly a lot more than just the the coupons, but just the fact that interest rates fell meant you're really, especially long-term bonds, provided this sort of safety. Now there's like this feeling we don't have safety anymore in bonds. Now, whether this current set of circumstances since the pandemic is permanent, some people are saying it is, some people are saying bonds still have a role. It's just important to provide that as an illustration. But of course, there are other people do have other assets in their portfolio. That's their own home, real estate, etc., like that. This is more like your investable, I guess, liquid assets. And there are ways to within these instruments here, especially shares, of course, and funds, to get involved in real estate and commodities. If you think commodities are better than bonds, to provide some kind of insurance in your portfolio. So it's just to say that these instruments you mentioned here, I think it's capture potentially a lot more and a very big universe of investable assets out there.
Yeah, and that's a very good point, actually. Even during COVID, we have seen some correlations weakening, but I do think that there are some exceptional cases. But historically, we have always seen that shares and bonds tend to be kind of very strong asset classes that move in opposite directions depending on the market circumstances. So I do believe that over a long time period that those rules will remain intact. But especially in the past 4 or 5 years, we have seen a lot of strange things in the market happening. So don't take for granted that kind of the academic correlations always hold. Sometimes market behaves in ways that are completely unexpected. But maybe just to emphasize here, the last kind of asset you can own is cash. As you know, cash still matters. I think it gives a lot of stability and flexibility, but of course, it detracts from your long-term gains. So I think you should match each building block here in the slide. And as John also emphasized, there are the investable liquid assets on a platform, but of course there are many different types of also different assets you can own as private companies, real estate, if you're lucky in infrastructure, and there are so many different types. But this is maybe the most common traditional assets that are available on a trading platform. And I think you should just match each of these with your goal and time horizon, as we will see later as well. So it's not that one is better than the other, or it's just, depending on your risk appetite, depending on your time horizon, and depending what are your goals, then you should slice and dice those assets and the allocation accordingly. And as I just mentioned, goals come first. So it's key to know kind of what are your goals, because the same investment can be sensible for one goal and very risky for another, right? And that's, I think, depends a lot on your time frame. Short goals like 0 to 3 years, of course, usually need more stability, less volatility, less risk of a permanent loss of capital. So you should match those short-term goals with maybe assets that are appropriate for those type of goals. So it can be cash, bonds, or ETFs, for example, very defensive ETFs. Medium goals can take a bit more risk, but still need some care, right? You cannot be like one single stock portfolio if you have a 7-year goal of buying a house, for example. So, or educational goals, for example, paying tuition fees for a very expensive university in the US. Then you should kind of match the assets accordingly. You can take a little bit more duration risk, but at the same time you need to know what level of volatility can still be acceptable for a 5 to 7 years goal. And last but not least, and those are my favorite, is the long-term goals. So goals that you need the money in 10 years or more, and those can often handle a little bit more volatility. There is more time to recover, and you want to maximize kind of the return or the compound rate. So here you can actually allocate a bit more to equities. You can take maybe as a satellite strategy or option some single stock bets. You can choose more ETFs, and you can just go a little bit more into shares compared to the other asset classes. And how do you reduce your risk then in this latter case, where you want to maybe have more exposure to shares and equities? Well, here it comes diversification. One stock can disappoint, and it can disappoint for reasons that have nothing to do with the economy. So a product fails, a competitor shows up with a better solution, a CEO leaves. There are some macroeconomics, I don't know, inflation going up, interest rates going up. there is also correlations with the macroeconomy that we should be aware of. So one stock can disappoint for several different reasons. What you don't want to be is just be invested in one story, one company, and being at the mercy of the market in that single name. So diversification basically spreads the single name risk and enable you to tap into a new and broader set of opportunities. And this can be obtained in several different ways, right? You can buy, as we mentioned, funds and ETFs, and they help because they give a broad exposure to kind of a sector or an industry or a geography without the need to pick kind of the winner or the single stock that you believe that will win the race. So it and of course, just is important maybe here to emphasize the fact that it does not reduce or remove completely the risk of a market drop, or just the normal ups and downs that we see in the market. It mainly reduces the avoidable damage from being too concentrated into one story or one name. So broad funds and ETF can really diversify across many companies and regions, and it doesn't take that much effort to do it. So I think the beauty is that it's a very easy way to being very diversified and still show your conviction. If you have a strong conviction in a specific industry or geography or a sector, or you can still find an ETF that is suitable for your strategy. And just the last point, remember that diversification is also being aware of what moves together and what moves in the opposite direction. So of what I would call correlations in the market. So as I mentioned, diversifying helps you avoiding kind of avoidable damage, but you still need to be aware what are the correlation within the eggs in your basket, because you might think that you have different eggs in different basket, but you might have a lot of eggs that move together when things go sour. So I think just be aware that there is not only it's not only just a number of if I have 20 stocks, then I'm diversified, or if I have 5 ETFs, I'm diversified. No, it doesn't work that way. It works more you have to think more in terms of, okay, do I own uncorrelated stocks and assets that move in different directions depending on the market environment, or am I overexposed to one specific trend that actually is highly correlated, even if I feel like I have many different stocks, for example, in my portfolio. So you should diversify on purpose. And this means it's not just owning many different things randomly, it's owning different things that do not all move together. So you can diversify across asset types, as we have seen. So equities for growth, bonds for stability. That's a typical allocation. You can diversify across sectors. So you avoid that maybe your portfolio is overexposed to one single story. And of course, you can diversify across regions. So you're not dependent on one country. I think John in the beginning, in the introduction, mentioned the fact that we have a company in Denmark that is really struggling lately, especially in the stock market. And you don't want to have that local bias of owning local champions, because maybe one or a couple of years can go really wrong, and then you're overexposed and your portfolio might be significantly down simply because you have not enough geographical diversification in the portfolio. So as we have seen, I think, and this is just reiterated in the slide, the key message is diversification is not just owning many things, it is owning different kind of things, and that especially that behave differently when markets change. So, and this is important for two main reasons. Market have the period of their favorite stocks or the favorite sector, and you want to benefit from them, from those periods, and you want to have some exposure to kind of the beneficiary of those periods. And is also the opposite is also true. So markets has period where they just penalize a lot of sectors, geographies. In some years can be emerging markets. Lately we have seen software companies being really penalized in the stock market. So we see those cycles of kind of the sentiment in the market changing and penalizing or favoring different type of sectors, industries, and sometimes even just specific stocks. So by owning different kind of things that behave differently, you can both benefit from this dynamic and also limit the damage when the wind is coming in your direction. So when there are some headwinds, you can still benefit because you are diversified. And here in the slide, you can just see some examples on style. So if you're more exposed to growth rather than value, even just company size. So here is a bit more nuanced. We are going into a little bit more details. So it's not just the asset classes, it's not just the geographies, it's not just the kind of the type of asset you're owning, but it's also the style. So are you more exposed to growth companies? So you're just buying companies that are trading at high multiples, have high growth, but kind of are long duration stocks. So long duration means that the earnings will be pretty far away in the future and you're paying up now for those future earnings. Or are you more value tilted? So value is a little bit the opposite. So companies that maybe don't have a lot of potential for growth, but as those companies can actually be trading at very low multiples. So you find very good deals in terms of how much you're paying for each unit of that company, but at the same time, it's companies that probably don't have the same future potential as the growth companies. Also, in this case, I would recommend to just balance the approach, the style that you have when you're investing. So don't just chase the more glamorous, the more glowy companies. Remember that also the value names can provide a lot of stability and downside protection as well. And then we also seen in the latest rotation since the beginning of this year, right? Year to date, actually, in the US, for example, the S&P equal weight index is up 5%. The cap weight index is down 5%. So we are seeing it's down, sorry, is 0.1%. So we are seeing a kind of a little bit a wider exposure for investors. They're not just chasing the hyperscalers or kind of the high growth names anymore. So you don't want to be left out when the market change its direction, right? You want to be on board with the market. And well, I hope now you have understood why diversification matters, and hopefully along the lines also on why correlation matters. So it's not just about not putting all your eggs in the basket, as the famous proverb says, but it's mostly making sure that you have lower correlation among your investments, and that can definitely smooth the ride in the long term. So, and remember, I want to emphasize this because especially for long-term investors, in the short term, Warren Buffett would say the market is a voting machine. In the long term, is a waiting machine. So what does that mean? That in the short term, there are so many different factors that are outside of our control that can move share prices. Whereas in the long run, the only 100% correlation that we have seen historically and empirically is earning per share and the share price. So if you can just silence all the noise and focus on the long-term returns, just remember that share price tend to follow a company's earnings power. So if you focus on that and you nail down kind of the future trajectory of those earnings, it's most likely that over a long time period, the returns will actually mimic or mirror this earnings power. So regardless of the correlations, if you're very long-term focused, just key to not be wrong on the earnings power of companies, which also takes a lot of analytical skills and takes some time to actually analyze and spend time to understand those businesses. So it's diversification is making sure that you don't have highly correlated names, but also remembering that if a company is losing its earnings power, there might be a high risk of permanent loss of capital over a long time period. So just to sum up here on the first part, what's the best playbook, since we have seen a lot of different information here. So I think there are 5 habits that matter a bit more than trying to be clever and trying to predict the future, which I think nobody is really capable of. So diversify, key to avoid huge damages to your portfolio. Automate your contribution. Here we are introducing a new concept, but that's also a way to dollar cost averaging the cost of your investment. So if you, instead of buying a lump sum and spend a lot of money and high risk kind of investing in one single stock or one single ETF in one go, you can actually just having the habit of investing. So you find a kind of a contribution or amount you want to invest every month or on a regular basis. So you can decide what's the frequency that you prefer, but you can just then invest that amount consistently over time. So by doing that, you will just kind of uh, average out a price, and instead of just being at the mercy of that single day on that specific session, and then you just buy the price on a specific session, you rather want to have kind of different entry points. When the price is lower, you will buy more units of the stock. When the price is higher, you will buy less units of the stock. So in a way, you then, by dollar cost averaging your positions, you're probably going to have over a long time period a bit of a lower price than the current market price, simply because of this dynamic that you buy more units when the price is lower, and then you buy less units when the price is higher. So just remember to be consistent and always invest the same amount, just to benefit from this dynamic.
I would add to that, Ruben, on the when to invest is so different. I think psychologically, if you're young and you're starting out, just get involved. The price doesn't matter. If this month's contribution that's from your income stream, and every month for the 100 months after, it's going to be a tiny amount in your overall investment returns for the very long term. So the price sensitivity really goes out the window. Of course, if you've suddenly come into an inheritance, you have a big, bulky single investment to make, then I understand the more time sensitivity there. That's my only general observation on that.
Yeah, very good point, John. And absolutely, those are just general recommendation. Then, of course, it depends on your specific case. And then I think people should understand that, also what I'm saying here is inspirational, and is not a specific recommend, or it's not a specific inspiration for a specific case. It's more general indications for best practices. I also think two important things to highlight in this slide are use a review schedule. So instead of being at the mercy of your emotions, and sometimes when the headlines are very loud and when the market is in a panic mode and everything is in the red, then you feel the urge to act. Actually, the exact opposite is true. So in those cases, you should just take a breath and wait maybe a couple of days, even better if it's a couple of weeks. And then you have a review schedule where, for example, on a quarterly basis, you go in and you assess your portfolio. So if you had, for example, an initial allocation and then some names have drifted, then you can bring it back to the original allocation. But then you do it just following a plan and not following your emotions. So I think it's good to write down kind of a date. It can also be just for very long-term investors like myself. I do it once a year. It cannot only just be once a year or twice a year, where you just, you bring it back to the original location. You just want to review your portfolio, make sure that if something has drifted too much from the original allocation, you just, out of discipline, you just bring it back to the original allocation you wanted for your portfolio. And along with this, maybe you can also write down some rules for what not to do when you're panicking because the market is not behaving as you expected. So now we move. I will try to be a bit faster. So I just want to leave a bit more space for your Q&A, which I think is the most interesting part. So part 2 is on risk. The goal is never to have zero risk. I think that's the highest risk, actually, not being willing to take any risk. But the goal is the right risk for your goals and also for your good sleep. So I'm introducing here a concept that I find very useful to assess what is your risk appetite and what risk you can take on because you can afford it. So we have two parts when we talk about risk ability and risk willingness. Ability is financial, so it depends on your income, on your debt, on how much emergency cash you want to have, and how long you can stay invested. And willingness is more emotional. It's more the kind of how you feel when the market drops. So I think you should understand your risk profile, and because that helps you then match strategy to your goal and a time horizon. So, and then I will always recommend to start a little bit kind of more balanced, more risk adverse. Even if you think that, I have the ability to take a bit more risk, I have the willingness, but maybe just I think you should go trial and error. So you should just try it out and feel how it feels when the market actually drops. So don't go all in immediately thinking or maybe overestimating what's your risk willingness or ability. So just take it step by step and adjust it slowly. But I think it's important to start a bit more balanced, and then if you feel like no, I can take a bit more, then adjust, but very slowly. um, and well, what to say here, a portfolio of course should fit both, right? The willingness, and your ability, because I mean if one of the two is not in line with the other, then your portfolio cannot be built in a way that is balanced and reflects actually what type of risk you can afford and you can emotionally tolerate. So remember that a plan you understand and suits your risk and ability is just easier to stick with compared to a plan that you're just building based on expectations that are not completely true. And also in this case, I think we should define risk depending on your time horizon, because it's very different when depending on your time frame, the type of risk you're exposing yourself to. So in the short term, volatility, for example, the price that moves up and down, which is quite normal, can be a risk. If you have a short term or a time horizon and the stock is down 25%, that can be very painful, especially if you have then to sell and you have to realize the loss. Whereas in the long term, it's more a risk of permanent loss of capital. So if you have a time horizon of 20 years, a daily drop, even if it's a significant one, a double-digit drop, you still don't care, because in the end, you're a long-term investor. You're a net buyer for the next 10 years. Sometimes I'm even happy when the stock is down because I can buy more at a discount. So if I was a buyer at $100 per share, I'm an even happier buyer at $90 per share. So it really completely changes the dynamic and the risk perception. In the short term, news and headlines and political stances and the macroeconomy can really move markets, and can move markets really quickly. Whereas I would say in the long term, the biggest risk is inflation, because I mean inflation is the only real uh, kind of thing that can completely erode your purchasing power, and of course also the value adjusted uh, worth of your investment. So inflation is the actual real risk in the long term, especially untamed inflation when it's a high single digit or low double digit. So very elevated levels of inflation can really eat up a lot of your real returns, right? Nominal returns can look amazing, but the actual real returns, inflation adjusted, can be really bad. So inflation is the real thing that to monitor for a long-term investor when you're thinking like 10 plus years. Uh, and remember also that a drop in the stock price, as we said, in the short term can be painful or uncomfortable, but it's not always dangerous. That depends on your strategy, depends on your time horizon, on your goals. So if you're a net buyer like I am for the next 10, 20 years, a drop can also mean buying at a discount, and then I'm not that afraid of that. Uh, Whereas in the long run, I think the biggest risk is actually behavioral. So what differentiate the Warren Buffett of this world from the average investor on the street is mostly their temperament and behavior. So psychologically, they just think differently. They can just stomach that volatility. They just don't care about a big price drop. They just have that type of temperament, that kind of behavioral stability that enables them to be uh, kind of wired in a way that they just see opportunities instead of panicking. So remember that a plan can always beat emotions, and the biggest risk is selling at the wrong time just because you're uh, falling trap of your own emotions. And here I want to emphasize the fact that risks come in different layers. So there is company specific risk, which is, for example, management not being aligned with your goals and objectives. Maybe it's very short term oriented. There is also product dependence or risk. So how much do you believe in the product? What's the runway of the product? Is a high? obsolescence risk product is a low. So you have to analyze company specific bottom up kind of what type of risk am I undertaking or willing to take here with this specific company. And those are called also idiosyncratic risks, and I think are the most important for long-term investors, because are always those that will at the end of the day show up, and then you pay the bill for if you have not recognized those in advance. Then we have the industry level risks, which is more kind of competition, regulations. Uh, uh, so it's more kind of risks that are specific to certain industries. So just have the awareness of, okay, what are the drivers of these industries? Or this industry is a kind of mega trend supported industry. So you have tailwinds, just given from the fact that there are some demographic shifts, or there are some consumer behaviors that will just provide a lot of tailwinds or benefits to this industry, or is an industry maybe in a structural decline. I don't know, maybe like tobacco or oil and gas today, which are seen in a decline. But it's not that in a industry which is booming and an industry in decline, one is better than the other. It's just always depends on what's your goal, what's your time horizon, what is the price those securities are selling at. So don't just overlook the fact that it's not only the industry drivers that matters, it's also the price that you pay to participate in that industry that is also very key. And then we have kind of the macro top down risks, which is the market or the economy risks. I will also add the political risk here. So it's big recessions, interest rate changes, global major events, climate catastrophes, geopolitical tensions. It's all those aspects or factors that come from above, come from governments, states, whole countries, and that we have little control over, but they can really influence the market. The good news is, especially in the short term, short to medium term, depending on how big the event is. Then three quick tools that can help a bit kind of balancing risk and reward. So helping understand a little bit how much risk you're willing to take. So as we said, diversification. Don't put all your eggs in one basket. That definitely helps with reducing your potential loss and kind of reducing the risk of being overexposed to one theme or sector. Then there is an industry KPI that we use, an industry proxy for volatility, which is called beta. So beta is a Greek letter, but it's also an indicator that we use to measure and engage volatility in the market. So above 1 means high volatile, below 1 means very low volatility. And then, as we've seen, be aware of your risk tolerance, know your comfort zone. So, and last but not least, I want to illustrate what kind of portfolio you can build based on your risk profile and your risk appetite. So you can have a conservative profile where 60% is in bonds, so a bit more steady, a bit less volatile, and then you have a 40% allocation in equities, very geographically diversified. Then you have the moderate, which is a 60-40, and the aggressive, which is only 10% in bonds. And sorry, moderate is 70-30, so 70% stocks. But then we will see a proper example, a bit more tangible later on in the presentation. Then we move to part 3, or the most interesting. So now we move from the why to how. So this is where we design a portfolio that matches your life and not just your mood. A good portfolio is not one with the best stories, as we have seen, is the one that matches your profile, but also can actually hold through good and bad times. So we should always think, as when we think about portfolio construction, in terms of asset allocation. So the split between equities, bond, cash, and other assets that you want to own in your portfolio. So this is a big driver of your returns over time, and it's also how your portfolio will feel and behave when things go well and when things go wrong. So the best allocation is not a 70-30 or a 60-40, is the one that you stick with when you're tired, busy, worried, amid a lot of volatility. So it's the one that you can actually hold through the good and the bad times. An approach that I would consider as best practice is having a very strong, broad, diversified, low cost core. So the core of your portfolio should be in high conviction, diversified, and low cost assets. Can be single stock, ETFs, bonds, investment grade bonds, for example. And then the satellites. So you can have then a 20% or a 30%, or depending on how you want to set up your asset allocation. But then you can have a satellite. So you can have small satellites, which are maybe smaller bets and focused ideas that you want to explore, that you maybe have a proper understanding of, and you just want to have kind of, I don't know, you really like, for example, the biotech industries. You find a great pharma company that you think that is going to be the next unicorn. You can allocate as a satellite a small percentage of your portfolio in that specific focused idea because you really believe in it. And the rule of thumb is always that the core does most of the heavy lifting. The satellites are just smaller bets that you're just doing because you want to test out an idea, because you have high conviction in something, but you don't want to lose a lot of your capital because of your satellites. So satellites is a bit more speculative bets, but they're within a weight that enable you to take those calculated bets. So this is just a very simple example of a moderate profile portfolio. So we have the core that is 80% of the whole portfolio, which is composed of investment grade bonds, American stocks, European equities, global market equities, and some local equities. And then we have the satellite. This is, for example, an example for an European-based investor, for example, that he's quite exposed to US and Europe. He has some high-quality bonds. And then the satellite, where you have few bets in gold, different commodities. You maybe want to generate a bit more income with the Dividend Aristocrats ETF, and some emerging market that can add volatility, but in good times can also improve the alpha returns of your portfolio. Now let's talk about a process hack. So this is not about portfolio construction per se, but it's more about, okay, how can I stay consistent when emotions try to make me time the market or to scare me? So don't be spooked by the market, but just, as I mentioned before, regularly invest an amount of money, because it reduces the pressure to time the market, and you benefit from time in the market. So you stay invested for the long run, and you kind of you reduce your average price, or at least your dollar cost averaging, and it also helps you with being consistent, to build that habit of, okay, I regularly invest in this. So it becomes more of a plan, of a process, and it's less tied to your emotions or the headline of the day. And as I mentioned, rebalance on schedule, not when the market is the loudest. And this is just a nice example on the power of compounding. So we are seeing two people here as an example, Anna and Ben. Anna starts very early. So she invests $50 per month from the age of 20 to the age of 40. Then she completely stops adding any new money, but leaves the investment untouched and leaves the investment to grow. Ben waits and he starts investing when he reaches the age of 35, and he's contributing $1,000 per month. And he also invests for 20 years until the age of 55. So he invests double the money, so double the monthly amount, and for a longer period. And assuming a 7% annual return for both, here's what happens at age of 55. So Anna will have $700,000. Ben will have a little more than 500K. So it means that returns can earn returns. It means that she has contributed half of what he did for less time, and now she has 200K more than he does. So consistency beats timing. Starting early can even beat invest more money each month. I think this is just a nice visual representation of the power of compounding.
A small point there, Ruben. I think you said $50 per month that she invested, and
500.
I think the example was 500. But so yeah, she invested half of what he did was the main point, and yet those returns were what they were. It's just because I think I heard 50. Just a small correction there.
Thanks could be that I said, yeah, I meant 500, of course. Okay, now we've come to the last part. We make this in this section is the idea is to make it a bit more actionable. No heroics, just a playbook you can use already today. It's a simple tools. I hope it will fit your level. It's very basic. Um, and it's also using a lot of our platform tools, which is quite rich in terms of the tools you can choose to select instruments. And so I hope you will find this very actionable and useful. And I hope you will already start using those tools today. So what tools can you use to select actual instrument and to find them? So on our platform, SaxoTrader Go, but also SaxoInvestor, we have a something called screener, a stock screener. So you can find different criterias for both stocks, but also ETFs to choose what companies or what ETFs you want to based on some criteria, very simple criteria. For example, market size. It can be some valuation criteria, very geography. So it can help you kind of narrow down the investable universe for you. And so that's a very good tool that I will recommend you to take a look at, just to find new ideas, to browse for new investment, new stocks, new ETFs. Just trying to play around on the screeners, choose the filters, change them, see what comes up. And I would always use a very broad criteria just to have a bigger investable universe, and then I will just look at every single name and then analyze a little bit and choose myself. So I do think that it's good to have a broad investable universe, and then you do your research, your due diligence to find the few or those names where you feel comfortable actually pulling the trigger. Then we have community and forums. Can generate a lot of ideas, but it can also generate a lot of noise. So treat them like a brainstorming room, not a rule book. I think it's very key to kind of take with a pinch of salt everything that is said on those community and forums like Seeking Alpha, social media, Reddit, and all of those platforms. Then we have educational resources. You can go to our inspiration page. You'll find a lot of our work, and we do a lot of research on markets, commodities, options, companies. You find a lot of good sources, and we try to use very good sources when we do our analysis. We try to be very objective. We try to kind of showcase how to step by step analyze different themes, stocks, sectors. So go to our inspiration page. You will find a lot of stuff. But then, of course, there is pages like Investopedia, Monthly Fool. On YouTube, there is plenty of educational resources. And then, last but not least, I do think that books are very helpful. It's just the knowledge of one person in 200, 300 pages that you can absorb and just learn a lot. So The Intelligent Investor is a classic. One Up on Wall Street is another one that I would highly recommend as great books for anyone that is starting now investing, or even for advanced investors. I think it's always good to brush off your memory with those good books. And then where you find information on the companies when you actually go into the analysis, when you go and do your research. So I would always go to kind of forced kind of the best is always the investor page of the companies. So that is where you find the annual reports, the 10K, 10Q. There is the investor relation pages. They often have very good presentations. If they have an investor day, then you'll find plenty of information, and it's actually the most reliable. Of course, it's reliable because it's fact-based information, but it comes from the company. So it comes from with the intention of convincing you to invest. So you always need to be a bit more balanced, a bit more neutral. And so take also those information from the perspective of, is someone that is incentivized to sell me the story. But it's definitely very good sources. Then, of course, we have Yahoo Finance, TradingView, Google Finance. There is analyst research on our webpage. You can also find in actually SaxoTrader Go or investor page, you can always find the FactSet consensus analyst target price. So you can see if it's rated as sell or as buy. And that can also be an indication. Remember that also brokerage houses can get this wrong, so it's not that it's a sell and a buy is not set on stone, right? Then we of course follow the news. We have plenty of news outlets that are quite renowned and reliable. So Reuters, CNBC, Bloomberg, Wall Street Journal. So you choose New York Times. You choose which one suits you and you like the most. And last but not least, on our platform, uh, you can find a lot of news from third-party providers, a lot of news that we as strategists actually create, and analyst ratings, and a little bit on fundamentals. So if you click on the stock and then the subtab called fundamentals, you can see some valuation metrics and some income statement metrics. And it's actually quite good snapshots of the company, of the key metrics that you should look at when analyzing a company. And that is a perfect segue to this simple checklist to find quality stocks. So just briefly, here you should first and foremost understand the business. So understand how the business generates the revenue and makes money is very key. And it sounds like something that you will take for granted, but it's impressive how many people struggle to understand the basic dynamic on how this company is monetizing its product or services. Second, look at the business quality. This means is a durable demand, what's the competitive landscape, what's the state of the balance sheet, has sensible debt, is too much debt, what's the conversion rate to cash, so is it actually generating a lot of cash, or is more these accounting standards that enable the company to hide a lot of weakness. Then of course look at the kind of the management, the quality of the management, the track record. Are they consistent? What do they do? What they say? Do they say what they do? uh, what about capital allocation? That is also a key part of your long-term returns. Are they good capital allocators, or they buy back the shares when it's at all-time high, and then they pay dividends when the shares is trading at a 50% discount? Are they doing sensible M&As, or just following the market when everything is crazy expensive and they start buying new companies? So there is a lot of things that you can actually check and to assess the quality of management, and I would highly recommend to look at management very closely, because it's one aspect that many investors overlook, and is one key element of long-term returns for investors. Last but not least, make sure that you pay the right price. So there are some multiples to earnings, to book value, some free cash flow yield measures that can help you figure out. Then, of course, it depends on the growth. It's more of an art than a science, but you can still be disciplined when it comes to evaluating the company, and make sure you're not overpaying for what it generates today and is what promises for tomorrow. But remember that tomorrow is unknown and the promises cannot materialize. When choosing an ETF, it's a little bit different. So it takes a little bit less of these analytical skills. It takes a little bit less of this deep dive work. But I think you should always start with a purpose. So when choosing an ETF, think or ask yourself, what role does the ETF play in my plan? So this is very key to start with, right? Uh, then you want to also choose if should be something core or more satellite. Check the costs, because of course small fees can matter over long time periods, and we have seen big differentials in how much those ETFs charge. And also maybe the practical details that a lot of people forget can be very key. So for example, liquidity, how closely the ETF tracks the underlying index. There are some ETFs that tend to have a very highly correlated um, link to the index, and others that are quite uncorrelated. So make sure that you are buying the exposure that you actually want. And also, if the ETF is the core, I think simplicity should be key. So just remember to keep it very simple. Don't unnecessarily take risk, for example, by taking, I don't know, a currency risk, or don't just try to be too smart in a way. So don't go for the 10 times leverage crypto crazy ETFs if you don't really understand the product, simply because you see the graph that is done like super well in the past. Those tend to be those investments that in the long run really don't work out as you would expect. So this is an example of the most common and different types of ETFs that can give you exposure to different geographies, styles, strategies. And of course, here you can slice and dice depending on your risk appetite, time horizon, your goals, as we have seen before. And as we have said several times now, it's not that you need, secret tools or a crazy good ability to analyze companies. You need a repeatable process, you need discipline, and you need to understand those products. So, and just make sure that they align with your plan. So that's the most important. It doesn't take an IQ of 200 to be a good investor. And finally, let me wrap up what we said so far by summarizing kind of the talk in the 4 chapters. So first, we talked about why diversification matters. And diversification matters mostly because it protects you from avoidable accidents, like one stock or one sector that goes wrong, but also enables you to tap into a broader set of opportunities. Of course, it does not eliminate the risk of market downturns. And we know that we should pay attention of correlations, because during stressful times, the correlation often rise and they show up. So make sure that you have an understanding of how correlated my products are and how I'm reducing these correlations among my asset classes and also within the same asset class. And also remember that in the long run, the anchor is still the fundamentals. Over time, prices follow earnings power, and then we can use as a proxy EPS. Second, we talk about risk and risk tolerance. Risk is not only volatility, as we have seen. Risk is mostly behavioral. Behavioral in the sense that it's your choice sometimes to sell at a loss, especially if your time horizon matches maybe a longer time frame. The key is matching your ability and your willingness to risk to your portfolio. So you don't get pushed to sell or buy at the worst time. You just follow a disciplined approach, and you're matching your portfolio with your risk tolerance, and which means ability and willingness. Third, portfolio construction. Here we have seen that asset allocation is the main steering wheel of your portfolio construction. And a simple core and satellite structure works really well for most people. So a broad, diversified core that you keep it very low cost, and then smaller position for specific ideas that are kind of revolving around the core. A little bit like our universe, right? And then fourth, we looked at how to select instruments. We have seen that we have so many different sources that even Saxo platform is really great with so many different type of content, third-party news, our own content, our own analysis. We have some fundamentals. We can see kind of the consensus analyst ratings. We can see we can find new ideas using the screeners and filtering out for specific criteria. So remember that there is plenty of information, and maybe the challenge today is more to focus on the signal in all this noise. So keep your sources reliable, but remember that there is also a lot of noise out there. And so with that, I would say we can move to your questions. And I
And
apologize.
no, don't apologize, Ruben. It was great. You got through so much material. There's so much to chew on there, and I hope people will take the opportunity to review this. I mean, there was just a massive amount of wisdom and good sound principles to guide yourself on if you're looking to build a portfolio for the long run. Yeah, you've just put up that link there, Ruben. That's great stuff. Please follow that QR link and provide us with some feedback. And I'm going to kick us off with a Q&A. I've had a chance while you're presenting, Ruben, to run through these, and I've earmarked several of them. You're of course welcome to go through these. I've also got some that I can ask you. I want to try to field a couple of them myself to start off with. The most important one I want to field first is there are a couple of people asking about, do we get the presentation? Now, of course, you can review this webinar and the recorded version later when it's put up on the Saxo webinar page. But if you go up to the right there should be a handouts section next to the questions. Well, it's sort of a tab-like structure up there. It's on the menu up there on the right. And you can see that Ruben's PDF is available for a direct download if you just want to, review that offline.
On this last point, just for your information, you can find in the appendix. So we also have some appendix. A slide
Great.
that I find it super useful to assess the correlation between your different holdings in the portfolio. So you can use this table to help you assessing what the correlations are in the portfolio. So it's what type of questions you should ask, and what is the driver that should move the stock, and what are the KPIs to test within your stocks. So take a look also in the appendix. You can find great sources, also great resources also in the appendix.
Good stuff. Thanks for pointing that out. And then the second one that I wanted to field was somebody asking about what are the probabilities of recession next 12, 15, 18 months? And I think that's the whole point of this presentation was to say, we don't know, and we don't want you to try to find out either. It's the key is to have a plan here. There were so many predicting a nasty recession after the big rate hike cycle we saw in 2021 into 2022. The recession didn't happen in 2022. It didn't happen in 2023, and we're still waiting for this recession to come. So those that sold back then and are waiting for that recession, when is it coming? I don't think. I don't think I'm qualified to answer. Of course, I have some opinions as a macro strategist, but I've also been wrong and right at times on where the economy is in the past. And then this is one of my favorite ones, both from an investment point of view, but especially from a trading point of view. And somebody asking how to know when to sell to avoid, I think the quote was, a permanent loss. And to me, it's really, really important. While I think we can think of the market as something that, at least in nominal terms, should over time drift higher. I mean, after all, our currency's value is drifting lower, so the markets on a long-term time frame have always, as long as they've stuck around, and you're not investing in imperial Russian stock markets, and then you have the Soviet Union or something like that. Okay, so you can't rule out massive historical catastrophe. Markets drift higher over time, and that's what you're counting on. But individual investments, there's no rule that says they have to, quote unquote, come back, right? Maybe they will, maybe they won't. So this idea that, and it's called anchoring. So I bought at this price. Now it's fallen by 50%. I haven't lost 50% until I sell it. That's my permanent loss. I encourage people to think of whatever you see on the screen, that is your loss already. The question is whether you think this is going to come back or to continue lower, or just, could your money be deployed more usefully elsewhere? At the same time, you don't want to actively manage all of your assets that way. But for single investments, I think it's useful to think of not having this anchoring bias as one thing. And then here's one, Ruben. So I think a lot of people concerned about this. Particularly, we have a heavy European base, I'm sure, on this call as well, seeing some of the names and some of the questions. This idea of this allocation to U.S. assets. I mean, what is the U.S. equity market weight in global portfolios? It's only order of 70%, 70%. Great reasons for this. The U.S. has some absolutely amazing, spectacularly profitable companies, the most massive ones in the world, the Mag 7 and more on down the line. Insane profits, and the valuations, of course, to a degree track that. And how do they avoid that U.S. allocation? It's quite simple. You can tilt your portfolio this way or that. Just by having only 50% of your portfolio in U.S. stocks, you are already taking an active view in global sense on U.S. equities. I don't know if you want to add anything to that, and I'll dig up a couple more questions.
Yeah, absolutely. Maybe just one point also on the previous question, which I found super interesting. I think for a long-term investor, especially when you're exposed to a single stock name, so a company, then you should always look at the underlying business. So, I mean, we all make mistakes, and sometimes we are wrong on the future prospects of a company. But that should not be based on the stock price. Should be based on analysis of how is the underlying business doing. So is actually the revenue declining? Do I expect this trend to continue? So if we see a worsening of the fundamentals, then I think it's justified to sell at a loss even. But just cut your losers immediately. Don't hold too much into a loser, which is not easy to define, but it's always not. It shouldn't be based on the stock price. I think the mistake that a lot of people do is that they look at the stock price and it's down 20%, and it's like, I was wrong. No, it's not that you're wrong or right. Let kind of give some time for your vision to play out, for your thesis to play out. But at the same time, being focused on the underlying business is key, because if you get the real figures from the business and those are actually declining, and you have a kind of high certainty that it will continue to decline, the share price will follow. So I think for long-term investors, the only indication is to look at the business, the fundamentals, and if they deteriorate, it's very likely that the share price will follow. So
And
just focus on the business, don't look at the share price.
that's very important advice. And we're also in a very unique time technologically with this whole introduction of AI and what that is bringing in terms of the market, attempting to predict who are going to be these AI winners and AI losers in the future. Who knows how successful the market is going to be? Yes, there's some that have been going crazy to the upside, especially this idea of the picks and shovels of AI, the memory makers, the hard disk makers, those that are enjoying the professional services needed and the components needed to build out data centers, the energy inputs into the data centers. This is all going great now. I don't know if we've projected too much or if we haven't projected enough. And then you're seeing the on the flip side, you're seeing the market trying to predict AI losers, and we've seen some very dramatic action in software names even before we started to see, and maybe we won't see, maybe we will see damage to their actually quarter results rolling in. So that's like you said, Ruben, when you start to see those news items actually rolling in that their business is declining, maybe it's time to sit up and take notice. There was somebody asking about Duolingo. I can see the logic of why Duolingo might be disrupted by AI. If you could just chat to an LLM, why is Duolingo special? I don't know. Maybe they can come up with some answer to the technology threat there. But we've seen the likes of this technology disruption in single names. I mean, look at Nokia, catastrophically disrupted by both BlackBerry and the iPhone and Android phones. BlackBerry itself completely disrupted, almost out of existence. And technology is a very, very tricky area. Spectacular profit potential, spectacular disruption risk as well.
Yeah.
And that's why. And then there's sort of connecting that with some of the questions about, well, what if I had this spectacular company? It's become a very large percentage of my portfolio because it's done so well. Should I sell it? Isn't that a dumb decision? I don't know if it is or not, but maybe you might want to reduce it so your whole portfolio isn't in one name. That is the whole nature of diversification risk. But by allocating to the general market, you are always going to pick the big market winners as a function of, if they are large, as a function of being exposed to the market. So if you have owned the US market in recent years, you've been participating in all of these spectacular companies becoming bigger and bigger over time. Now, in the past, that's been risky because, let's say in the 60s and 70s, some of these massive companies were a very, very big part of the overall index. And these got disrupted by poor business models and being poorly run. So not all times are the same, but some thoughts there. But you can respond to any of that, Ruben, as well.
Yep.
There was one specific person calling out our notion that diversification isn't necessarily a great idea, saying Buffett recommended a high concentration, high conviction approach. I would only point out that most of Buffett's relative success in the market came in the 60s and 70s when there was a lot of absurd deals in the market on fundamental terms, and that he actually underperformed the broader index for the last 2 decades before he retired recently. But anything from that huge ball of wax I just threw out there, I'm happy for you to pick it up, Ruben.
Yeah,
I've got some more questions as well.
Couple of things. So on the US, especially from the perspective of an European investor, I think it's important to highlight here that you're taking 2 bets. One is on the USD currency risk. So you're investing in US dollars, right? So then you have to have some sort of idea of, okay, how to hedge that risk, or maybe the direction.
Oops. I don't know if you are also seeing this, but the connection to Ruben just cut out there. I think that is the risk. We are getting along in time here. We've gone to 75 minutes. Let me see if there's anything else I wanted to just call a key question. There was a question: what's the difference between SaxoTrader and SaxoInvestor? And I would say the chief point here is, if you're an equities only investor and you're not interested in the other extensive asset offerings that we have, and you're not taking a more active approach, SaxoInvestor is your platform. It's a lot simpler. It's a lot more beginner friendly. If you're much more engaged and active investor, especially if you want to reach out into other assets and trade more frequently and invest more frequently, and look at other types of assets, then the SaxoTrader is the platform you may want to consult there. We got you back, Ruben. It looks like you went out there for a second.
Yeah,
I'm not sure when you discovered mid-answer there, when you were cut off. I was busy looking for a question while you were answering, but I'll let you pick up the thread where you where
Yeah,
you
I don't
lost
know
it there.
where, but I'll just try to summarize what I was trying to say. Just that if you don't invest in your own currency, you're taking two risks. One is the currency risk, and the other one is kind of how the underlying asset that you're investing will fare. So just remember that every time you're buying a US stock, you're taking also that currency risk, and you have some to have some sort of hedge or idea of what the direction of that currency and against your own currency. But on the US, just briefly, I think it's a great market. Historically has been kind of the outperformer of globally for many years. I think the ability of innovating and kind of the capitalistic society like is the best expression of capitalism probably, and this the best expression of people being able from scratch to build something incredible, and they have all the conditions to let this happen very organically. But I also think that the best years of the US are behind us. So if you expect the S&P 500 to yield anything between 8 and 10% like the past 50 years, I think that's very unlikely. I think the next 50 years will be more like 3 to 5%, simply because the economy has become so big and the opportunities for incremental growth are simply less. So the kind of the opportunity set is shrinking. That it doesn't mean that you cannot find some single stock or some ETFs or some pockets like AI or technology or that are very strong. But overall, I think the economy is a little bit like Europe 50 years ago, right? The best times for Europe was probably between the 50s, the 60s. We had a booming in the 80s as well, but in the end, uh, we are old economies with a good welfare, and so the potential for growth is simply increasingly less than it was maybe 20 years ago. It doesn't mean that it's not a great country, it's not very stable, but it still means that probably, especially if you buy the basket approach with an index, the expected returns, in my opinion, will not be as high as they were in the past 20 years.
I think it's a key point, but there's also the question of, and I think part of this is the whole passive allocations and allocations of portfolios. And because the US is the largest market, it gets rewarded with the largest allocations. The idea of expected returns. Now, that's always really tricky because, what are valuations or what should they be versus what they actually are. Arguably, the U.S. market, for example, has been horribly overvalued for years, and yet it just kept continuing to deliver on those spectacular returns. But I think I would add that as a potential, at least a longer term reason why potentially the U.S. market returns could fall short of much of the rest of the world. We're seeing some signs that the markets are allocating to other pockets of the world. We've seen and this is not a recommendation, just an observation. We saw last year Europe outperforming. Some of that may be down to allocation more into weightings of portfolios more back into Europe. The idea that in this uncertain world with Trump pulling the rug out from under the security alliances, NATO, etc., that Europe needs to stop recycling savings so much abroad. And even some individual investors don't like what's going on and saying, I don't want to invest as much in the U.S. And that those flows have their own impact as well in terms of bidding up values. So
Okay.
just a couple of observations there.
Maybe one observation on my side on I think there was a very good question on diversification versus kind of a concentrated portfolio that where you show your conviction. But I do think that it's not an eternal conflict as it might look like at a first glance. So you can actually have, as we said, the core and satellite approach, where in your core, for example, you can allocate a 20% out of that 80% of your core portfolio to a specific idea or a high conviction name, bet or sector, ETF, whatever it is, in your core. So I don't think that diversifying excludes completely the idea of showing your conviction. It's just a more balanced approach where you avoid being putting all your eggs in one basket and being overexposed to a theme or an industry or a company. But it's just you can show your conviction. You just you want to avoid. Not even Warren Buffett has 100% of his portfolio in one stock, right? Probably Berkshire Hathaway has more than 25 stocks right now, and he's been priming Apple for the past few years. So when one position becomes really big, he's the first one on to review on schedule, and then kind of if something has drifted too much, he brings back the allocation to the original plan. So we're not saying that you should just being completely diversified and avoiding showing the conviction. We are saying show your conviction, but with a balanced approach where you know with what type of risks you are taking, and just you're not putting all your eggs in one basket, but you're still showing the conviction, maybe with a 20% allocation in the core, right? To a specific idea where you believe this has huge potential in the long term.
And then there's some very, very difficult questions, and these are specific scenarios where people have mentioned in the question their age, tend to be a bit closer to retirement, and concerned about the returns and concerned about preserving values. We kind of mentioned this a bit early in the webinar on maybe being a bit more concerned about allocating towards an income approach as opposed to a stock approach. And I'll just make an observation here. There's some good reasons that people are concerned about bonds. They've been badly burned by owning bonds from the era of zero interest rates, especially if you took a long-term bond yielding almost nothing, and then interest rates go to 3% or higher. That's been an ugly experience. Now, I would say at present levels, if inflation stays where it is, and if bond yields stay where they are, the return profile looks a little bit better, and even slightly positive returns in some cases. But if you are worried, I personally, my longer term outlook is I am somewhat concerned about these national debt levels and what that means for the potential returns in bonds. Then owning something that at least should maintain its value is something that's a very important consideration. So you can balance. This is not a specific recommendation, but one approach could be to balance the bond percentage with ownership of hard assets, and that could be commodities producing companies, whether it's more cyclical commodities like copper and other industrial metals. Some of this has been very popularly linked to the data center build out, or to precious metals, or both, as a sort of something that can maintain its value in a time of inflation when people are seeking these very hard assets. There is a reason that gold and silver have done what they've done over the last year and 10 plus. That is part of that concern. Whether it can continue at this pace, I don't know. Certainly, the real value of these metals is very, very high relative to what they could buy versus what they could buy in the past. But if inflation is here to stay, then maybe the 10-year forward debt looks very different. So I would just make that one observation. And then there's just to connect it to the questions. There was somebody saying, oh, there's no simple copper or platinum tracker. For sophisticated traders, you can find some of these trackers for directly participating in the price, but there are many stocks that participate in these industries. There's yes, it makes the things more complicated when you buy mining companies, because there's also the cost of the energy inputs, the quality of the mine, the ore grades, the political interference potential because it's off in some other country, all this stuff. But there are companies out there that can offer fairly direct exposure and sometimes leveraged exposure if the prices of these underlying materials goes very high, to participate in that space. Just if you want to do your own follow-up research on that. I think we need to kind of close it out with a single other question or comment. Ruben, I think this is the longest I've ever allowed one of these webinars to go on. So is there any one you'd like to pick out? Also on that lump sum idea, it's a very difficult question, but I think it's key for people. The general advice is for somebody that knows they need to have that wealth preservation as they're about to enter retirement to reduce the percentage of the portfolio that's allocated to the most volatile asset classes.
Yeah. And maybe I've also seen a recurring question is around kind of, isn't the US market kind of highly correlated with the rest of the world? And so if it goes down, and then also someone else says something like, but now US companies are now worldwide companies. So kind of the dominant effect. So it doesn't really matter. Then I guess the question is if you invest in the US or Europe, because then they all move together. That's not completely true, I would say. Like there are some correlations, of course, and that's why I emphasize so many times in my presentation that you should not think in terms only of, okay, I'm diversified because I own different things, but I'm diversified because I own things that move differently. So Europe definitely has different drivers than US, but they have also some drivers that are in common. So of course, a geopolitical tension between Greenland and US can cause some repercussions in both countries. A rate decision often is being mimicked, or Europe follows a little bit US when it comes to rate cuts, and so there could be some implications for European markets when the US cuts or raise the interest rates. But generally speaking, there are two different economies with different drivers. And as John mentioned also before, Europe has outperformed last year compared to the US. We have seen some rotations also internally here in Europe where, we don't really have many tech names. Software names are being really hammered in Europe as well. So it's a bit more of a defensive, value-oriented market. So it's less growthy compared to the US. So I would say there are remarkable differences, to be honest. And it would be wrong to say, well, if I own the S&P, it's same as the Eurostoxx 600. No, it's a completely different universe of companies, and I would also say it's slightly different drivers that will move those markets. So remember that it's two different geographies that can be correlated to some extent, maybe in some macro factors, but they're mostly independent and uncorrelated. John, you're muted. Okay, I unmute you.
Okay, sorry about that. We're gonna have to wrap it up there. Save the technical glitch there for the very end. We'll wrap it up there. Thank you so much for attending today. We hope you found this session useful. I really appreciate the engagement and all of your questions. Again, you can find the recording, you can find the handout if you're still logged in here on the upper right. And yeah, let us know via that survey how we can improve, and we'll be bringing more of these sessions in the future. Look at the just Google Saxo webinars. You can find the upcoming webinars that we will be hosting from our side. So for now, all the best and take care out there.
Thank you for joining. All the best.